Okay, cool. You tell me it's easy to buy or simple to buy a business. How do you actually do it? Jose Pio here, aka The Lone Soldier. The last video, we went over how I teamed up with my buddy to buy a landscaping company, some of the pitfalls and some of the benefits to doing that. Now we're gonna go into how you get the money. That's what matters, the money. How do you get the money to buy that business? Because you see all these gurus on YouTube talking about, you gotta do this, you gotta do that. None of them talk to you about how to get the money. So what you're gonna do, number one, you need to get the seller's numbers, meaning I need the last 3 years tax returns. I need the current year-to-date P&L, profit and loss statement. You're gonna go through those numbers yourself because the numbers they're gonna give you are bull stuff. They are not right. They never are right. They're gonna over-embellish everything. They're wrong. You're gonna go through your own numbers. If you don't know how to go through it, you work with someone like me to go through those numbers. Because what I'm gonna do is I'm gonna break those numbers down, and I got a spreadsheet and everything where I just plug it in and automatically gives me my numbers that I am looking for. But to give you a very basic, crude understanding of what I do, I go to the net income. How much money did they actually make? Looking at the SDE number, which is seller discretionary earnings. You're looking at the EBITDA number, the earnings before interest, tax deductible, and appreciation. These are things that you need to, amortization. These are things that they're going to give you that number. They're going to say, oh, this person brings home $100,000 a year. Cool. I need the numbers. I need to figure that out myself, whether or not they do that. Because what happens a lot of times, those numbers are wrong. And it could be wrong in a negative way, and it could certainly be wrong in a positive way. Because you're looking at it from your perspective. Are you buying a business because you're going to get into that business, or you're buying the business because you're going to put it underneath your current business and you are looking to do a lateral move, or you're looking to grow horizontally or vertically, whatever it may be, whatever is up to you. What you want to accomplish by buying this business depends on how you're going to look at those numbers. Because let me give you insight into what we had to look at. We were already a landscaping company. We already had the employees. We already had all the stuff that goes into having a landscaping company, including the accountant and attorneys, right? So when you're buying another landscaping company, they have expenses that you are already having, right? You already have insurance. You already have employee expenses. You already have accountant expenses. You already have all these different things, that your cell phone expenses. You already have those expenses. And so what they're taking home is actually less, a lot of times, than what you can count as the value of that business to your business. So when you're looking at the SDE or EBITDA, those numbers are pretty much interchangeable when it comes to small-based businesses, when it comes to solo entrepreneurs or owner operators. When it comes to that level of business, those two numbers are pretty interchangeable. Let's just say, for example, they tell you that the revenues are $350,000 and the earnings, or the SDE or EBITDA that they bring home, is $100,000. What you're looking for is to spend a lower multiple on that $100,000 as possible, because you want to get that money back quickly as possible. Within 3 years is the goal. So you want to spend up to 3x multiple on that. Now, if it's a SaaS company, a software company, a monthly subscription company, those are different. A media company, those are different. They have different, multiples on them. When it comes to a small owner operator business, the most you want to spend is 2 to 3x multiple on that SDE or EBITDA numbers, and net income numbers. So what they give you is one number, but you want to go through the numbers and see for yourself what the actual profit level is. And you can work that yourself, or you can work with someone like me. I'll do that for you, and I'll tell you exactly how much you should be spending on this, what the low end of it is that you can maybe get away with it, or what the high level is. But the whole basis for it is how you can get the freaking the money. You have to know the numbers, though, because when you approach a bank, that's the first company you're going to go to. I might take that back. There is a such thing as the owner holding note. That does happen. It is not impossible. It's usually not for very much, but it's not impossible. So how you use that to your advantage is, let's say this company is earning $100,000 a year take home pay, and the numbers, let's just say the numbers are correct, $100,000. You want to spend $300,000 or less to buy that business. Let's say the seller is saying, I want that $300,000. Cool. I'll give you what you want, seller. but I need you to hold note. That's exactly how you say it. I'll give you the amount of money you want, but it's on my terms. They'll usually say, all right, tell me what it is. And you say, I need you to hold 25% of that $300,000. 1/4 of that will be, let's just call it even $75,000. I need you to hold $75,000 in a seller's note at 6.5% interest rate, probably nowadays like 8% interest rate for 5 years. And I'm going to get you the other money because you're going to utilize that owner holding note as your down payment when you go to the bank, because the bank only gives you they don't give you the full purchase value. It's like buying a house. There's not much difference there. When you go to buy let's just use even numbers here, $100,000 house. They want to see a down payment because they're not going to give you $100,000 to buy that house. They're going to give you, let's just say, $80,000 to buy that house. That $20,000 is usually a down payment. In the business world, you can use the owner holding note, the seller holding note as your down payment. This is the amazing world of business finance. That person, that seller holding that $75,000 on that $300,000 note means that the bank says, well, we're only going to give you $225,000 on a business that's clearly worth $300,000 plus. Yeah, that's lower risk. So you just combine two different ways to get the money right then and there. If the owner says, I'm not holding any note, cool. I'll give you $250,000 for the business. Yeah, I'm not giving you the full amount because I have to come out of pocket my own money for the down payment to get a loan, or you pay cash if you've got that. So I still need money to operate the business, even though technically the money is coming in immediately. Month one, you're paying for cash flow. Again, you're not starting a business fresh and then hoping that someone comes in. No, you're buying a business that's already cash flowing. You're paying for money. You're paying right now today for money that you're going to earn over the next few years. So those are two ways. Number one, owner holding note. Number two, well, technically three ways, owner holding note combined with the bank holding the rest of the note. Number three, there is a such thing as alternative financing, and you can use the assets of the business to actually get a loan on it. A business that you don't even own yet, you can use the assets of that business to get a loan. Let's just say it's a manufacturing center, right? So it's got the real estate and it's got the equipment. The equipment's worth $200,000. The real estate's worth $200,000. They want $500,000 for the whole kit and caboodle because he's just looking to retire down in Florida and get some nice, suntan. You can actually utilize the real estate and the equipment to get a loan on that. It's not difficult, but you have to know where to look for that money. The alternative financing route is not easily given to you. It's not freely given to you. And there are quite a few options out there, but you can use their assets to lend off of and close the same day as you buying the business. You're literally getting a business loan on a business you don't even own. It's insane. I know. Another way is you can actually get a personal line of credit, whether it's your home equity line of credit. I don't necessarily think that's the best route because you're using your own personal house for a business debt. It's not the greatest way to do it, but in order to get it done, you can do it that way. So there's money available out there. You have to know what to look for with the numbers. You want to spend the least amount as possible, not because you want to get the best deal. It's because you need to get that money back within 3 years. And that's what the bank is looking at as well. They need to make sure that, number one, the revenues and the profits there can afford the loan and you can pay it back. And if you have a bad month, there's still enough of a profit level where you can keep adding additional profits so that the month that you did bad on, there's enough profits to cover it. But that owner holding note is huge. It really is a huge way to utilize that as your down payment to then go to the bank and say, I just need this amount of money to buy this amount of business. It's an awesome way to get it done. It's technically zero money out of pocket. You might have to pay for escrow. You might have to pay for some closing costs and attorney. But in the grand scheme of things, If you're spending $5,000 to buy a $100,000 per year profit company, spend it. These are the things that I help people with, business owners with, anyone who's looking to get into business with. Any questions, feel free to reach out. Comment down below, say, help me, an exclamation point. If you are looking to do the same thing, I can help guide you through exactly what we were able to do and what I've been able to help other people get done as well. Talk to you later.